What if the market crashes in reverse? A puzzling question, isn't it? Picture a scenario not where stocks plummet but where they skyrocket, causing an economic phenomenon we call a reverse market crash. This isn't a page from some fantasy novel but a reality that has happened before and may very well happen again. Let's wind back the clock to the tech industry's rise following the 2011 dot-com bubble. As the dust of the bubble settled, tech stocks didn't just recover, they exploded, creating a surge in wealth for those invested in the sector. But it also widened the wealth gap, leaving those without tech stocks trailing behind. A similar scenario unfolded recently in Turkey, where stock prices rose dramatically, once again creating a wealth divide. So, what fuels these reverse market crashes? Well, two factors often play a significant role: wealth disparity and inflation. Wealth disparity can create a volatile market environment where a select few control a significant amount of wealth. This concentration of wealth can lead to rapid price escalations in the assets they hold, which can result in a reverse market crash. Inflation, on the other hand, can be a bit trickier to understand. When inflation rates rise faster than wage growth, people's purchasing power decreases. This can lead to increased investment in assets like stocks, as people search for returns that outpace inflation. And when everyone starts pouring their money into the market, it can artificially inflate asset prices, setting the stage for a reverse market crash. What does this mean for investors? It's essential to be aware of these patterns and make strategic decisions to protect your investments. Diversification, for instance, can be a good strategy to spread risk and potentially benefit from these market anomalies. A reverse market crash may be nearer than we think, and it's crucial to be prepared. Today's market is as unpredictable as ever, and understanding the concept of a reverse market crash is one way to stay ahead of the game. So, keep an eye on the horizon and plan your strategy wisely. Let's delve deeper into the roles of inflation and wealth disparity in a reverse market crash. When we talk about inflation, it's important to distinguish between nominal and real rates. Nominal inflation is the rate at which the price of goods and services increase over time. Real inflation, on the other hand, takes into account the purchasing power of your money. If your salary increases at the same rate as nominal inflation, you might think you're maintaining your purchasing power. But if real inflation is higher, you're actually losing ground. Historically, negative interest rates have often signaled economic crises. They mean that lenders are essentially paying borrowers to take money. This was the case in the 2008 financial crisis and the 2020 COVID-19 shutdown. In both cases, negative rates were a desperate measure to stimulate economic activity. Now let's look at the current state of the middle class. It's often said that the middle class is shrinking, but this isn't because wealth is disappearing. Rather, it's due to changing economic circumstances. A booming economy often leads to wealth concentration at the top, leaving the middle class proportionally smaller. Take the example of Germany's market crash. Even though their market increased significantly, the purchasing power was still lower than in the United States. This is a classic example of a reverse market crash where the nominal value of assets increases but their real value decreases due to inflation. Wealth disparity too plays a major role in reverse market crashes. When asset prices balloon, those who already have substantial wealth can ride the wave and accumulate even more. But those who are not as well off can find themselves left behind, further widening the wealth gap. Inflation and wealth disparity are key players in the drama of a reverse market crash. They can rapidly change the economic landscape, creating winners and losers. Understanding their dynamics can help us navigate the treacherous waters of a volatile economy. The U.S. economy's current state might seem daunting, but there are ways to navigate a reverse market crash. Let's take a closer look at the current state of the U.S. economy. We have noticeable political divisions, higher inflation than the Federal Reserve desires, and yet we've seen consistent GDP growth for the past 50 years. Moreover, the U.S. still holds the status of the global reserve currency. In contrast to countries that have experienced sky-high inflation and catastrophic reverse stock market crashes, the U.S. is unlikely to face the same outcomes. These countries saw their markets soar by 10,000%, and yet their currencies lost nearly all their value. In such scenarios, tangible assets like food, ammunition, and other essentials became the only things of real value. However, this doesn't mean we're immune to the effects of a reverse market crash. Inflation, for instance, could erode our purchasing power, leaving us with less real wealth even if our nominal wealth increases. And then we have the wealthy investors who, with their high risk tolerance, can capitalize on short-term price fluctuations, further increasing wealth disparity. So, how can we survive a reverse market crash? The first step is to save more than we spend. It's a simple principle, but it's often overlooked. By saving, we build a financial buffer that can protect us from unexpected economic downturns. Next, we should consider diversifying our investment portfolio. A well-diversified portfolio can help protect against the volatility of a single market or asset class. It's like the old saying goes, don't put all your eggs in one basket. Lastly, we must focus on what we can control. We may not be able to influence the global economy, but we can certainly control our job performance, skills development, and personal finance management. By focusing on these areas, we can improve our financial stability, regardless of the broader economic climate. A reverse market crash can be a daunting prospect, but with strategic planning and a focus on what we can control, we can weather this financial storm. So, what have we learned about reverse market crashes? We've delved into the concept of a reverse market crash, a sudden ballooning of asset prices, enabling some to amass significant wealth, while others are left in the dust. We've drawn from historical examples such as the tech industry's boom post, the 2011 dot-com bubble, and the recent surge in Turkey's stock prices. We've understood that wealth disparity and inflation are key contributors to these crashes. We've differentiated between nominal and real rates of inflation and their impact on the economy. We've also touched upon the current state of the US economy, its political divisions, inflation rates, consistent GDP growth, and global reserve currency status. Finally, we've offered survival strategies in the face of a reverse market crash, saving more, diversifying investments, and focusing on what's within our control. Remember, knowledge is power, so arm yourself with this understanding and prepare for any financial storm that comes your way.